Gold and silver are not drifting lower. They are not correcting. They are not consolidating. They are falling in real time. As this is being recorded, gold is breaking levels that were supposed to slow it down. Silver is slicing through prices that, until days ago, were considered impossible without a global shock. Every refresh shows a lower number. Not hours apart. Minutes apart. Friday was supposed to be the climax. The violent flush. The day the damage was done and the system stabilized. Instead, Friday appears to have been the opening act. This is not what exhaustion looks like. This is acceleration. And when markets accelerate after a historic sell-off, it usually means something deeper is being forced beneath the surface. The screen is telling you one story. Reality is telling another. The explanation arrived instantly, as it always does. Too much leverage. Too much speculation. A crowded trade finally breaking. It sounds logical. Comforting, even. It suggests the system corrected itself. But real corrections behave differently. When an asset collapses because demand genuinely disappears, the pressure eases as price falls. Sellers emerge. Inventory loosens. The market breathes again. That is not happening. Instead, as prices collapse, access tightens. Selling intensifies in financial markets while physical availability vanishes. That contradiction alone tells you this is not a demand-driven event. It is an enforcement-driven one. And enforcement does not care whether you are right. After Friday's crash, thousands of traders believed they would exit Monday morning. They held through the weekend, expecting volatility but access. They did not get it. Orders were rejected. Systems froze. Circuit limits blocked exits. The market opened lower, but many participants were not allowed to participate at all. That detail matters. Markets break in two stages. First, price moves. Then access disappears. By the time access disappears, the damage is already being distributed. This is not accidental. It is structural. Most people underestimate margin because they treat it like a technical detail. It isn't. Margin is the lever that turns volatility into liquidation. When exchanges raise margin requirements, traders must post additional cash immediately. Not later. Immediately. One hike can be absorbed. Several in rapid succession cannot. When hikes come repeatedly, positions are not exited by choice. They are terminated by force. This is what creates cascading sell-offs. Not fear. Math. And once that cascade begins, price no longer reflects value. It reflects who ran out of collateral first. This is where the story stops being local. Margin pressure did not rise in one market alone. It tightened across major exchanges within the same window. Systems that rarely move in sync suddenly acted together. That is not normal. Coordination does not require conspiracy. It requires shared risk. When institutions fear the same failure point, they act in the same direction. The direction here was unmistakable. Reduce exposure. Force liquidation. Prevent delivery stress. Here is the divergence that matters. Paper silver is collapsing. Physical silver is holding. In some regions, buyers are paying dramatically more for real metal than the screen price suggests. That gap is not closing. It is persisting. That tells you the crash is not clearing supply. It is clearing leverage. If silver were genuinely becoming abundant, physical buyers would retreat. They are not. They are absorbing everything available. This is not retail behavior. Removing millions of ounces of physical metal requires logistics, security, and intent. It is not done impulsively. Large entities are taking delivery while prices collapse. Vaults are being drained, not replenished. That is the opposite of panic selling. It is preparation. The timing of this event is not random. Major delivery periods concentrate stress. When paper promises exceed physical availability, the system must reduce demand before accountability arrives. The fastest way to do that is through collateral pressure. Shake out enough participants, and fewer remain to ask for what was promised. That is the logic. Nothing about the underlying reality has improved. Supply remains constrained. Industrial demand remains elevated. Structural deficits have not disappeared. Only one thing changed. The paper price. That tells you where the pressure is being applied. This is not a market discovering truth. This is a system enforcing limits. Paper can be printed. Collateral can be adjusted. Rules can be tightened. Metal cannot. When paper and physical diverge this violently, it is not because reality changed. It is because the system is trying to delay reconciliation. That delay never lasts forever. The only question is how much damage occurs before it ends, and who is still standing when it does. This is not chaos. It is a transfer. And once you see that, you stop watching the price alone.